Hi there. In this video, we'll examine what happens when an outside IR35 contract becomes inside IR35 and the resulting financial consequences.
A simple email arrives at 4:30 p.m. on a Friday. Your £500 a day contract has just been reclassified to inside IR35, effective Monday. The message doesn't mention a rate increase. The client expects you to absorb the financial hit entirely on your own. This isn't happening because your daily working practices changed. In the 2026-2027 tax year, businesses are rushing to eliminate off-payroll risk because of the sheer scale of retrospective tax liabilities being handed down by HMRC. Look at the post office. They recently disclosed a £104.4 million IR35 tax liability. That is 9 figures of unpaid PAYE, national insurance, and interest, generated because they incorrectly assessed their IT contractors over several years. When clients issue a status determination statement, they are legally required to take reasonable care. If they fail, the liability for those unpaid taxes can shift directly to them. Rather than risk these massive bills from HMRC, clients are issuing blanket inside IR35 bans across their entire contractor workforce. I'm a tax advisor with My Tax Accountant, MTA. We help contractors calculate their actual financial exposure and negotiate terms of these sudden status changes. Today, we are going to run the exact numbers on what an unadjusted shift inside IR35 costs you, and we'll look at the specific strategies left in the 2026-27 tax year to mitigate that damage. When a client moves you inside IR35 overnight without adjusting your rate, they are not fixing a compliance issue. They are taking their own financial risk and transferring the cost directly onto your balance sheet. Let's start with the baseline control scenario. You operate outside IR35 through your own personal service company on a standard rate of £500 per day. This waterfall chart breaks down £110,000 gross revenue. First, extract a $12,570 director salary. Remaining revenue is subject to corporation tax, then drawn as dividends. Applying 2026-2027 dividend tax rates of 10.75% and 35.75%, your final net take-home pay lands between £75,000 and £78,000. Did you know, even with the dividend tax increases in 2026, the financial gap between inside and outside IR35 remains vast because of how employer national insurance is handled? The personal service company structure isolates your earnings. You pay personal and corporate taxes, but heavy employer-level payroll taxes remain completely out of the equation. Now look at what happens when that exact same $500 day rate is forced inside IR35, requiring you to use an umbrella company. This side shows the umbrella model. Your $110,000 assignment rate isn't gross salary. First, the umbrella deducts its margin, the apprenticeship levy, and a massive 15% employer national insurance deduction. Since this comes from your billing, your net take-home crashes to just £60,000. Moving inside IR35 on the exact same day rate forces you to fund both sides of the tax ledger. You pay the employer's taxes to employ you and the employee's taxes for doing the work. To survive an inside IR35 determination financially intact, you must recalculate the baseline of your contract. The math dictates a required rate uplift of 15. If a client refuses to adjust the rate, there is one robust defense left in the 2026-27 tax framework to claw back efficiency: pension salary sacrifice via a compliant umbrella company. This flowchart illustrates the mechanics. Diverting a portion of your assignment rate directly into a SIP bypasses employer national insurance and income tax calculations entirely. Higher rate taxpayers save up to 48%, keeping that wealth securely within their pension pot. But the window to use this strategy is closing. Legislation passed in the Autumn Budget 2025 severely restricts this workaround. An absolute statutory cap on national insurance exempt salary sacrifices takes effect on April 6, 2029. Any pension sacrifice exceeding £2,000 per year will instantly attract standard Class 1 national insurance contributions. Both the 15% employer rate and the standard employee rate will apply directly to your retirement contributions. As a contractor navigating this market, you have 3 clear rules. 1. Never absorb employer taxes. 2. Demand the 20% uplift. 3. Max out your pension. Do this before the 2029 hammer falls. This video provides general guidance on UK tax rules and is not professional advice. Individual circumstances differ. Obtain professional advice before making financial decisions. If you are dealing with an aggressive IR35 transition, reach out to the team at My Tax Accountant via the email and website on screen for precise, personalized guidance. Proactive financial planning ensures you retain your hard-earned wealth rather than paying the price for a client's compliance panic.